It is an honor for me to introduce today's panel of speakers for our year-end Planning for Organizations webinar. Today, we kick off with Tony Licavoli, Raymond's Director of Tax Consulting. Tony leads a team of subject matter experts in providing strategic tax planning and consulting services. As a trusted advisor, Tony is passionate about demystifying tax complexities for clients and empowering them to make informed decisions. Following Tony's section today, we're going to move into Jerry Benjamin. Jerry serves clients in an advisory capacity and provides fractional CFO services to small and middle market companies. He assists organizations with strategic planning, managing liquidity, assessing and improving key business processes, developing financial teams, and strengthening financial reporting so that there's an emphasis on improving operational performance. And finally, last but not least, is Katie Stewart. Katie Stewart is a senior manager with our HR solutions team. Katie provides her clients with what they need most, whether that's as big as a full service human resources support team or as small as offering her knowledge on human resource related inquiries. Katie serves clients across a variety of industries: manufacturing, healthcare, professional services, nonprofits, and more. But with that, we are really excited to bring this panel to get together today to talk to you. And with that, we're going to go ahead and turn it over to you, Tony.
All right, thank you, Sam, and good afternoon, everyone. Sarah, if we want to move right into the first slide here. So, we're, 2.5 weeks past the election. The dust has really settled, and really it was pretty much decided within the first day or so. So we now have a complete picture of what the political landscape will be, at least in 2025 and 2026. And basically, if you can look at the results here, although most people are probably already aware, it's pretty much complete Republican control, with some limitations in the Senate where a majority isn't necessarily enough, but we'll talk about that in a little bit too. So again, just looking at the results here, obviously you have the executive side with former president or President-elect Trump now winning comfortably on both the Electoral College as well as the popular vote. In the House, there is a comfortable lead as well that not all the seats have been decided. I think I checked this morning, and I think it was 219 to 213 actually, with still some seats to be decided, but still a somewhat comfortable lead in the House, and then a 53 to 47 lead in the Senate. So now that we have at least some certainty on who's going to be in power for, again, at least the next couple of years, we want to talk about what does that mean for tax policy. So basically, what can we expect from the Republican Party going forward into the next 2 years? And, we're talking about this a lot. And, initially kind of the answer seems simple at first, right? It's going to be Republicans. It's going to be focused on tax cuts and different areas that are related to tax cuts. But as we'll talk about, it's really not that simple. Even when you have one party who holds a majority, like the Republicans do in both the Senate and the House, you still have a pretty broad range of ideas within each individual party. So within the Republican Party in this case. So, if we look at an idea like tariffs, at the very least within the Republican Party, there are mixed opinions on whether or not tariffs are a good idea. And to some degree, you've got people within the Republican Party saying they are not going to support any type of blanketed tariffs. So again, when one party has a slim majority like we have here, they can't really afford to lose more than a few people. And in some cases, it can be down to a single person. Again, each member holds a significant sway over really what gets into law or what goes into a bill, and just importantly, what stays out of it. So a perfect example of this is if we go back a couple years to what was called the Build Back Better Act. That bill was a Democratic bill that they tried to get through the House and the Senate using reconciliation. And that was basically stalled by one Democratic senator who did not vote for it. So you can see one single individual can really impact policy, even if they're in the same party that's trying to force through partisan policy. So again, as we talked about 2025 tax policy, it's important to keep in mind this idea because, again, sometimes it does come down to that small group of individuals who can really be a roadblock in terms of passing tax legislation. All right, so if we can move on to the next slide, we'll talk about a couple two bullet points on there, in terms of what we actually do know for next year. And that is the first item, or really the second item on that list there, is the expiring tax provisions, or what's been called or dubbed the tax cliff. So there are about $4 trillion of tax increases that are scheduled to take effect starting in 2026. And that's 4 trillion with the T. So these are scheduled to take effect, meaning that unless Congress does something, most non-corporate businesses are going to see some type of tax increase if nothing happens. And, it's important to point out, and as we'll talk about later on these slides, that, during his campaign, President-elect Trump had promised to address these issues, these tax increases. But, again, ultimately, the responsibility is going to fall on Congress, right? Congress is the one that proposes tax laws. They write the tax laws and they ultimately tax laws. So again, just keep that in mind as we talk about this. But if we can go on to the next slide here. So let's talk about what's going to expire, but actually let's first look at on this slide here, what provisions are going to stick around for sure. So just some background at the top of the slide, you see the Tax Cuts and Jobs Act, and some background on the TCJA. These were the significant round of tax changes that took place back in December of 2020 or 2017. And these tax changes were not a bipartisan effort. So these were a strictly Republican tax bill that, in order to get it passed, because of the specific rules in the Senate, the Republicans had to use the process that's called budget reconciliation. And because of this, and in order to do this, many of the tax changes, and in this case, the non-corporate tax changes, had to be temporary, meaning they are going to expire, they are going to sunset. And this is what we're talking about when we talk about that tax cliff, because all these provisions, not on this specific slide, but on the slides that we'll talk about next, are going to expire at the end of 2025. So when we talk about the $4 trillion, the temporary provisions are what we're talking about in this case. But before we get to the temporary provisions, let's cover on this slide here what's actually permanent, what's actually going to stick around. So, the first item over on that left-hand slide, the 21% corporate tax rate. So background on this, prior to 2017, if you operated as a corporation, and really when we're talking about corporation, we're talking about a C corporation, your tax rate prior to 2017 was a variable rate, somewhere up to about 35%. And it occasionally could get over that 35%, but then would drop back down. So in 2017, that was changed to a flat 21% rate for all C corporations. And that's going to remain the same. That is not going to change after 2025. The second item on there, the corporate alternative minimum tax, so the AMT. So this was repealed back in 2017 as well, only for corporations. It has since come back in 2022. It came back in a much different form, but the current corporate AMT only really impacts a very limited group of the largest corporations in the United States. So in effect, it's been repealed, or still is repealed for most corporate entities. Third box on there, some of the international provisions, the global intangible low taxed income, what's been dubbed GILTI, as well as the foreign derived intangible income deduction, which is FDII or FDII. These are going to stay in place, but there's going to be some significant modifications that come into play over the next couple of years. So ultimately, these modifications are going to lead to taxpayers who have GILTI or are taking advantage of an FDII deduction, effectively paying a higher tax rate on their GILTI income or a reduced deduction for FDII. Bonus depreciation, significant one for our client base for sure. This is basically the ability to write off immediately your fixed asset purchases, or for most of your fixed asset purchases. Now, we have this in the permanent section. It's actually phasing down right now. So although it's not expiring at the end of 2025, it's currently in a process of phase down. So from 2017 through 2022, it was 100%. 2023 was 80%, 24, 60%, and so forth. So this is scheduled to phase down to 0% by the time we get through 2026, but it is not going away in 2025. R&D expenses, again, for business owners, this is one that they're paying close attention to here. This was a change that basically requires you to capitalize your R&D cost and amortize that over either a 5 or 15-year period. And this change was actually a result of the 2017 bill. It did not actually come into effect until a couple of years in 2022. So it's been around for several years now, but it was actually part of that 2017 tax bill. So if we could go on to the next slide. So we talked about on the previous slide, the permanent provisions, those are the ones that are going to stay around, or at least stay around for a couple more years. Now, these are the ones that are expiring at the end of 2025. So this is the items that make up that $4 trillion of tax increases. First one on there, tax rates. Tax rates for pretty much every single bracket are scheduled to go up. And that top tax rate going up from 37 to 39.6%. So, if you think about our flow through entities, our S corps and our partnerships, they are effectively paying tax because that income flows out to those individuals. They are paying tax at these individual rates, with some exceptions that we'll talk about. So when you consider that, you have to think about your business, the tax that you pay on your business income is in effect going up as a result of this, if you are an S corporation or a partnership. Again, corporations are going to continue at that 21% tax rate. Over to the right there, the standard deduction, that's going to be cut in half. In addition to that, though, the old personal exemption is going to come back into play. Alternative minimum tax for individuals. So we talked about AMT for corporations. AMT for individuals in 2017 had some significant changes as well. It wasn't fully repealed, but what they basically did is they changed the exemption amounts and the phase outs in such a way that most individuals who would have been subject to this alternative minimum tax were essentially not subject to it anymore. So these rules are going to revert back to the old exemptions, the old phase outs, which means not only are you going to have higher tax brackets, as you can see up above, or higher tax rates, you're going to have more individuals that are stuck in that alternative minimum tax bracket, which is essentially going to lead to higher tax rates for them as well. Okay, so on to the next slide here. Child tax credits, these are scheduled to be cut in half. The state and local tax deduction limitation. So this is an interesting one because all the other ones that we're going to talk about are not taxpayer favorable. This one is, if it's allowed to expire, at least for many taxpayers. So what this basically did is it limits the amount of state and local income tax, property taxes that you can deduct on your 1040. So that was, as part of the 2017 bill, that was capped at $10,000. And again, that was a temporary provision. So as we get through 2025 and into 2026, this limitation is actually removed, and you can go back to deducting basically up into, you can deduct the same amount that you could prior to 2017, which is no limitation on the state and local taxes themselves, just an overall limitation on your itemized deductions here. So that one is actually taxpayer favorable if it is allowed to expire. The estate and gift tax exemption, so the last one on this slide. This is basically the ability to pass down wealth from one generation to the other tax-free. that exemption amount is currently set to basically be cut in half. It's inflation adjusted, so it's not these exact amounts. But so, what that basically means is there's going to be a lot of interest. There already is a lot of interest in estate planning right now because you don't want to put yourself in a situation if you do have a taxable estate where it's getting towards the end of next year and you're having to rush to do any type of estate planning because the Republicans couldn't agree on extending this or they didn't include this extension in that package. So again, if you are in a taxable estate position and you have not addressed estate planning, now is the time to do that. Okay, and then our last slide here, if we can move on, that related to the expiring provisions. These are a little bit more directly related to businesses. So the first item on there, the excess business loss limitation. So this was extended to 2028 as part of a more recent tax bill. So that's not expiring at the end of 2025. And what this basically does is it limits a business owner's ability to use business losses to offset other categories of income, like your interest, like your dividends, that portfolio income, even things like W-2 wages. So that is going to stick around at least through the end of 2028. And then the last bullet point on there, probably the most significant one for our pass-through entity business owners. So again, pass-through entities are our S corporations and our partnerships. For some context, the vast majority of businesses by quantity, or at least quantity-wise, operate as pass-through entities. So under the current law, pass-through businesses can receive up to a 20% deduction on their business income. And there's a whole bunch of limitations that you have to go through, but that's the max amount of deduction. Or if this is allowed to expire, you go back to the pre-2017 rules, and the pre-2017 rules is QBI, or the qualified business income deduction, did not exist. So you essentially would lose out on the full amount of this deduction. So again, that bullet point on there, if not extended, S corporations and partnerships will pay a significantly higher tax rate. So not only, again, if we go back to that slide on tax rates, not only are we going to see a higher tax rate, but you're also going to lose the benefit of this deduction as well, which, let's say you were paying a 37% tax rate. With this deduction, you were only paying, about a 30% tax rate effectively on your business income. So that could jump all the way up to 39.6% if all these items are allowed to expire. And that kind of takes us to our last bullet point on that slide there, increased interest in a C corporate structure. So if you remember, I talked about a 21% C corporate tax rate. So if your S corporations and your partnerships lose this deduction and the tax rate goes up to, let's say, 37 or 39.6%, that's a significant spread between a 21% corporate rate and a 37 or a 39.6% flow-through tax rate. So, the other thing to keep in mind is C corporations do pay a double layer of tax on dividends, but they can control, in most cases, they control when they pay that dividend. So, if I'm a business owner and this pass-through deductions allowed to expire, I'm definitely going to be thinking about C corporate structure for my business, because at the very least, I can defer a significant portion of my taxes until I decide to make that dividend payment. So again, a pretty significant item here. If it is allowed to lapse, you're definitely going to see more focus on the C corporate structures than you have in the past. In addition to that, corporate structures have some other significant advantages too, outside of just that tax rate differential. So certainly our flow through business owners will be watching this specific provision very closely. Okay, so let's go on to, we'll switch topics and we'll go on to what we're calling, I think in this slide, the presidential candidates proposals. Obviously, the slide was used as part of a prior presentation, but I wanted to keep it in because I know a lot of people are still interested in kind of comparing and contrasting the two proposals here. So again, if you look at the slide, we'll cover this in some more detail. Specifically, obviously, our focus will be on the left hand of that slide and not so much on the right hand there. But It's labeled proposals. I do want to talk about the use of the term proposal before we actually get into some detail here. Um, just a couple things here. Again, when we say or use the term proposal, I wouldn't think of it as a organized, sort of centralized written document that the Trump campaign or either Harris campaign, really for that matter, put out. It's more of there's some informal stuff, there's some stuff mentioned on the campaign trail, and we're just kind of grouping this all together and saying this is their proposals. And the other item to mention is all presidential candidates have proposals. Very few end up making it into legislation, right? If you go back to what I said, right, Congress is going to be the one that ultimately dictates what ends up in a bill. So keep that in mind as we walk through some of the detail here. As we talk about the two at the time, the two candidates' proposals, but if we're going to compare these two, the left and the right hand slide, and just kind of sum it up into a sentence or two, right? The left hand side of that slide is focused heavily, or the Trump proposals are focused heavily on tax cuts that are at least partially paid for with the use of enacting tariffs. So, I say partially, and Jerry is going to talk about tariffs some more. But I think even the most optimistic revenue estimates from the President Trump proposals, there's nowhere near budget neutral. If we contrast that to what the Harris campaign was proposing during the campaign, it was heavily focused on raising revenue through tax increases on individuals making over $400,000. So if that amount sounds familiar, is the exact amount that the Biden campaign used back in 2020 as well. Okay, so let's get into some more detail. If we move on to the next slide, let's kind of look into detail on the specific Trump proposals here. So the keystone of both, I would say, the Trump wish list as well as the Republican wish list is making permanent all of those expiring tax provisions that we just covered. So making those permanent, maybe at the very least extending them for a 10-year period. You think about the lower tax rates, the higher standard deduction, that 20% pass-through business deduction under I would call it both a Trump and a Republican plan. All of these would be extended. Now we'll get into some actual changes here. So that second bullet point on there, or that second category on there is lowering the corporate tax rate. So as I mentioned, that rate is at 21% now. The Trump campaign ran on a 20% corporate tax rate. So every corporation would see at least a 1% reduction in their tax rate. And then also probably the bigger item on here is that companies that produce products in the US would pay a 15% corporate tax rate. So I'll talk about that one a little bit more. Now, I will say that there's not a lot of details on how you get to a 15% tax rate here. In actuality, there's no details, but if we were to kind of guess how this would get done, there is a path forward with something that they can just pull out of prior existing law, and that is the domestic production activities deduction. So it was called DPAD. So if anyone remembers this, it was repealed several years back, but this is basically a deduction for companies that either produce goods in the United States. You can get it for constructing as well as designing goods too. But the key was it had to be done in the United States. And this deduction, it was not only a corporate tax deduction, it was a deduction available for flow-through entities as well. So your S corps and your partnerships could take advantage of this too. So if they do try to get down to a reduced rate for companies that manufacture in the US, they'll probably go the route of something like this deduction that they used in the past as well. And my guess is they would make it available not just for corporations, but also for pass-through entities as well. Okay, and then that last item on the slide here, restoring certain TCJA business tax provisions. Business owners are definitely going to be interested in this one. We talked about 2 out of 3 of these earlier. Again, bringing back 100% bonus depreciation so that companies, businesses could, in effect, deduct their full cost of their CapEx expenditures right in that year that they acquired it in. Second item on there, R&D expensing. Again, currently, businesses are required to capitalize those R&D expenses. And what that has done is businesses that go ahead and invest heavily in R&D to the point where they're actually putting themselves in a loss for the year, those businesses, because of this rule, are ending up still having to pay taxes because they're not able to deduct those costs, those R&D costs. So that that obviously discourages R&D being done within the United States. So this is one provision that does have bipartisan support. I don't think anyone is a big fan of this law, especially in its current form. Again, the question will be if it's included in a tax bill. If you're trying to go the route of a bipartisan effort, will the other stuff basically spoil the chances of passing this provision? Again, that's only if you go down a bipartisan route. And then the last one on there, the EBITDA-based interest expense limitations. So for anyone that uses a lot of debt, especially to purchase machinery and equipment, other types of CapEx, over the past couple of years since they changed the rules, you may have been subject to a limitation on your interest expense deduction. So this limitation is not proposed to go away. It's proposed to go back to the old rule, which is really a post 2017 rule. So it's not that old. But the old rule, which is basically going to make it easier for companies that utilize a lot of debt and have a lot of depreciation to still be able to deduct that interest expense in that year. Okay, if we go on to the next slide here, child tax credit. Both campaigns had a increase in the child tax credit. Not much to talk about there, but that was one thing that was proposed. I'm not sure if Republicans in Congress all agree on increasing it that high. So we'll have to wait and see on that one. The next one on there, this is an interesting one, the elimination on taxes of certain income. Now, and I didn't even include all the income that was proposed to be tax-free during the campaign because there's some more categories on there. But the first one on there, it received a lot of media attention and also was a proposal inside of the Harris campaign as well, and that is eliminating taxes paid on tips. So there'd be no federal taxation, at least on any tips that individuals owned. Again, probably more of a campaign talking point and a way to maybe appeal to certain individuals in certain states, in certain swing states. So again, I don't know if there's much of an appetite for that one in Congress. Social Security benefits, basically not paying tax on Social Security benefits. Again, this is a good way to appeal to a certain age group, just not sure to the Republicans in Congress in terms of their appetite for that one. And then the last one on there, I would probably say the one that I would not sure how serious to take this one as well, overtime wages or not having those subject to overtime wages. I will say, with this one, if they were ever to propose this and to pass this, it would be very difficult to administer, both from like a company or an HR standpoint, as well as certainly from an IRS standpoint, because you're certainly going to have pretty much everyone looking for a way, whether they're salary or hourly, they're going to be looking for a way to classify a portion of their wages as, this tax-free overtime bucket. So again, I don't think I would take that proposal very seriously, at least the way it's currently, or it was currently being talked about. Okay, so those last two items on this slide. So we talked about, revenue. We talked about what tax decreases. So how are we going to pay for them, right? How are we going to raise revenue to be able to offset at least some of the cost of these tax decreases? So the first one on there, the first really revenue raiser on there, is the repeal of the Inflation Reduction Act green energy credits. So some background here. the IRA was the law that, just like the Tax Cuts and Jobs Act, which was a Republican law forced through the Senate using reconciliation, the IRA was a Democratic uh, tax bill that was forced through the Senate using reconciliation a couple of years back. And inside of that, this law, you had the items like the energy credits for solar, wind, geothermal. You had the energy credits or the credits for electric vehicles, as well as charging stations too, and just a whole bunch of other ones in there as well. So, you know, just like, again, this was a Democratic led, non bipartisan bill. And now that the Republicans are back in power, it's going to be a target, at least to some degree, in ways, and when they're thinking up ways to raise revenue, they're going to be targeting these energy credits here. And then the last one, again, Jerry is going to talk about this a little bit more in his part, but imposing a universal baseline tariff on US imports, somewhere from 10 to 20%, and then a more punitive tariff on imports from China. So, this is what during the campaign, or if you got stuff in the mail or text messages, this is what was being called the Trump national sales tax. It's not that, but there's certainly no denying that. Number one, it's going to be, or it would be, a major shift in policy in the United States, and also within the Republican Party. And then number two, it definitely is going to create certain price pressures on goods with heavy import markets. So I won't go into any more detail on that, but again, Jerry is going to cover it in a couple slides from now. Okay, so moving on to our next slide and wrapping up with this slide. So let's talk about some possible outcomes here over the next year or so. So I've kind of laid it out in three scenarios: the stalemate, a strong arm, and the compromise. And we'll talk a little bit about each. Now, the stalemate was much more likely, meaning that basically nothing gets done. This was much more likely if we had a split Democrat and Republican Congress. That is not the case right now. So you'd basically have to have some significant Republican dissent, and enough to where you couldn't get to a majority in the House or in the Senate for this scenario to take place. So basically, this would sort of be, I guess, depending on your viewpoint, certainly from a tax increase viewpoint, this would be the worst of all these three scenarios here. So the second item on there, the second one, this idea of the strong arm, basically, Republicans, again, they control the House, they control the Senate, or at least they have the majority in the Senate, and they control the White House. So they can force through legislation if they can get full or close to full Republican support. So the only real nuance here is that in the Senate you do need 60 votes to pass something. If you don't get to 60 votes, there's something called the filibuster, which I'm sure many people have heard of. And basically that acts as a roadblock to getting any legislation through. And there's a way around the filibuster. And that's what we talked about reconciliation, right? We talked about the Democrats using it 2 years back. We talked about the Republicans using it in 2017. And the Republicans will have, I think, two chances in 2015 to use this reconciliation process. I know they've been having conversations on it all the way back to, at least what I've read, all the way back to May of this year, with the hopes that if we do sweep the House, the House, the Senate, and the presidency, that we're going to try to get through our bills using reconciliation within the first 100 days of taking office. So the only other thing I want to mention about this one is that, one of the things, or one of the nuances with reconciliation, is that you cannot increase the deficit after a 10-year period. So for all years after a 10-year window, that bill must be revenue neutral. So you've got 10 years to do whatever you want, but after that 10th year, that bill must revert back to being budget neutral. So this is exactly, if they do use reconciliation, this is exactly why we're in this position today, because they had to make all of these provisions expire after that 10-year window, in this case, the 8-year window, because of the rules of budget reconciliation. So the reason why we have $4 trillion of tax increases scheduled at the end of next year is because of the use of this process. Then I'll just point out the compromise, the last one on there. This would be some type of combination of one and two, something staying, something's going away. Again, this would be, I talk about compromise, I'm talking about compromise between parties. So this would be a Democrat and Republican joint bill. I would say I am not too pessimistic, at least now, if that's going to happen. All right. So with that, I'm going to turn it over to Jerry to continue on the conversation about tariffs.
All right. Tony, thank you and good afternoon. As we look at tariffs and just kind of setting a little bit of the background, for many of you, prior to 2018, tariffs may not have even been on your radar screen, or they may not have played any sort of a key role in your sourcing or pricing decisions. You may have been impacted by some relatively modest costs, and that was factored into your total landed cost picture. 2018 introduced a step level change, as the next slide will show, in terms of the impact. So I've just highlighted a couple of the items there. What was added on imported steel at 25%, aluminum, other products at 10%. But again, the key was in the third bullet point under history, which is looking at what was an effective 21% cost increase on average based on that $79 billion of costs or tariffs, if you will, applied against imports of roughly 380 billion. So an absolutely substantial increase in your cost structure, depending on your level of imported products. Now there was some expectation with change in administration that we'd see relief. And that really didn't happen. There have been some modest increases under President Biden's administration. And that's where we were. And now, just as Tony was laying out what we might be looking at based on formal releases as well as comments, I guess I would describe it, as we look at the potential section, as 2018 tariffs on steroids, and the chance that many of us could be living roid rage, if you will, to use that phrase, in terms of the potential impact on our businesses. Again, it may not have been something that was on your radar screen prior to 2018. You may have had seen minimal impact in 2018, but if indeed that baseline tariff of 10 to 20% on all imported goods were to be enacted, you'll now be pulled into the tariff zone, if you will. And it's affecting not only our businesses, our cost structure. We're seeing it come into play in the marketplace. It was interesting, in today's Wall Street Journal, there was an article that said the Trump stock euphoria starts to fade. And the first item was tariffs. Tariffs, deficits, and stretched valuations give Wall Street pause. Now, while we don't know specifically what the outcomes will be for these tariffs, and again, you can see them on the screen, whether it's the baseline that Tony mentioned, and I think he mentioned both of those first two items: the baseline, the additional punitive tariff on imports from China, as well as a potential additional tariffs on Mexico as part of a plan, I think, from a negotiating standpoint in terms of immigration policy. While we don't know what's going to happen definitively, we can certainly start to look at, and I would encourage all of you, if you are importing products or goods, to look at these steps and consider what might make sense. And step one is really to look at that total cost picture. If you haven't, I would strongly encourage you to look at your supply chain and focus obviously on those items that are being imported. But as you look at the items being imported, again, it's not just the item, but it's the stage of the item or the stage of where they are in the process. Are you importing raw materials? Are you importing components? Are the items in an in-process condition or are they finished goods? So that's one piece of the evaluation. The other piece will be to understand the countries of origin where you're currently bringing those products in. And from that, quantify the total cost that you're spending through your chain on these items. Now, armed with that information, we then can start to look at potential actions that would allow us to offset or mitigate to some degree the potential impact that we could look at or could be facing, excuse me, if these tariffs are enacted. And I've kind of organized them on the bullet points in some near-term actions and some longer-term actions. Starting with the near term, the first two items that you'll see there, pricing and purchasing, those really key on your ability to offset all or a portion of the estimated cost increase through the tariff cost increase through either raising prices to your customers, negotiating potential cost relief from suppliers, or a combination of both. And even when we look at that, it can't be done in a vacuum. We operate in competitive marketplaces, so you'll need that market intelligence to try to get a feel for what you expect your competition to do. If you believe your competition will not raise prices, that's going to severely impact your ability or may severely impact your ability to pass along those prices to your customer. So you may have to factor down your expectations to something that may be more achievable or risk pressure on your demand for your products. So pricing power and purchasing power, those are really the first two places I would look. Next, again, it would be tariff classifications. And I think it's something that can be overlooked and an assumption that the classification given your product is accurate, but it's worth investing the time and effort to review those classifications in light of the tariff schedule to understand, is there a way, is it accurate? Does it properly capture the nature of the product? And is there another option that is available that might provide a lower tariff? So again, it's looking at your existing products, and it's looking at your existing sources, it's business today, and how does that fit and how does that align with the harmonized tariff schedule? If we move on, then the next item in my near-term section is really somewhat of a cash flow play. This isn't avoiding duty per se, but it's delaying it or it's deferring it. And there's a couple of options that you can consider. One is a foreign trade zone. And again, that allows you both of these options, whether it's the foreign trade zone or a custom bonded warehouse, it allows you to defer payment of that duty until the item exits that zone or warehouse. And there are differences between the two that I just want to highlight quickly. The foreign trade zone allows you to do manufacturing and processing, whereas the bonded warehouse is primarily for storage. So it does depend on the nature of the items and what may or may not need to be done to them. The foreign trade zone allows you to store those items indefinitely, where the bonded warehouse has a limit of up to 5 years. And the foreign trade zone also provides for the elimination of duties if those goods upon exit are exported. So they're leaving the United States. So again, as we look at those first ones, the near term, we're identifying what we believe our cost impact could be. What kind of purchasing power do we have? Where do we stand with our suppliers from a negotiating standpoint? Are the products properly classified according to the harmonized tariff schedule? And are there options to delay or defer that duty as I manage cash flow? The next two items are really longer term and they involve some fundamental changes. So um, that's why it's important to understand the cost potential, the impact, because now you have to determine is that impact, that tariff impact, does it warrant taking these additional steps, which are significant? And there are two that are highlighted for you. One is tariff engineering. So now we're taking a product that we have today, um, and we're considering modifying it or changing the design really from a cost avoidance standpoint. So can you look at the materials? Can your bill of materials be modified in terms of the material used or the component used? Can you change the design of the product that might allow it to qualify for a different tariff level? If you're importing a finished good, can you convert your approach to importing components and then taking those components and assembling it yourself or assembling it in another country that would be subject to a different tariff level? And then finally, looking at those countries where we have free trade agreements. So the U.S. has free trade agreements with 20 countries today. The three that would be probably most used would be Australia, Canada, and Mexico. Obviously, Canada and Mexico being under the USMCA. And it's kind of surprising some of the examples, and the one that seems to be referenced more frequently has to do with Converse. So if you were a Converse All-Star fan, as I was, you wore those tennis shoes, and they literally made a design change where they added a layer of felt to the shoe. Adding that layer of felt allowed them to classify their tennis shoes as slippers and take a duty rate of 40% to about 3. So again, significant changes that you could evaluate if it's warranted, if the cost savings potential is warranted. The other item is to look at the country of origin. And again, another significant a significant point is just that are you looking for a supplier at a new country, or or can I change where the product will be materially modified? And that's referred to as substantial transformation. Those are really the keys. There's a couple of other items, but I think in the interest of time, we're going to move on now to Katie from an HR update. So thank you very much.
Thank you, Jerry. Appreciate it. Hello, everyone. Yes, here to give you some updates on HR legislation and compliance. We can move forward on the slides. Thank you. You can go to the next one as well. Thank you. So I'm going to try to cover this fairly quickly here. But for those of you that are Michigan employers, this will impact you. So anyone that previously or currently has 50 or more employees has been following the Paid Medical Leave Act, which went into effect in 2019. Well, ESTA, or the Earned Sick Time Act, is now going to be into effect on February 21st, 2025, and this will impact all employers with one or more employees. Move to the next slide. So what does this involve in terms of leave accrual and usage? So under the Paid Medical Leave Act, you were to accrue 1 hour for every 35 hours worked for your employees of paid sick time. There was a maximum of 40 hours to be utilized in a year, and the carryover was capped at 40 hours as well. Well, the Earned Sick Time Act has definitely expanded those rights. So now you will have to accrue paid time off at 1 hour for every 30 hours worked for employees. And 72 hours can be utilized by each employee in a year if your business has 10 or more employees. And 40 hours paid can be utilized for businesses with 1 to 9 employees. and then an additional 32 hours of unpaid time. And the way ESTA is currently written, the carryover is not capped as well. So in terms of counting the number of employees that you have, to see if you meet that 10 employee threshold, you're going to want to look if you have 10 or more employees in any 20 weeks within the current calendar year or the previous calendar year. And those do not need to be consecutive weeks in order to be considered at that threshold. So this includes all employees. So your full-time employees, your part-time employees, temporary employees as well, even through temp services or staffing agencies. And if you meet that threshold, then you need to comply with that number of employees for the remainder of that current calendar year and the following calendar year, and until you drop below that with the 20 consecutive weeks. Now, with the carryover not being capped under the way ESTA is currently written, if your employee has any unused time off at the calendar year or whatever benefit year you're looking to use, then that time will automatically carry over into the next benefit year. Now, you as an employer have the ability to define your benefit year, so that can be any consecutive 12 months. So that can be a calendar year, that can be a fiscal year, or it can even follow like your open enrollment benefit year, anniversary year for employees as well. So what this means basically is there's no cap on accrual. So employee can accrue that 1 hour for 30 hours worked with no cap. There's no cap on that carryover, as I said, but there is a cap on how much they can use per year. You can also choose to front load this amount of time at the beginning of each benefit year if you choose to do so. But you still have to follow the carryover rule the way the law is currently written. And the reason I keep saying the way the law is currently written, there is a proposed bill out there to make some changes to ESTA before it goes into effect. We will see if that actually happens, but some of these items would change slightly based upon that proposed bill. Now, an employee may use earned sick time as it accrues unless they are a brand new employee. So you'll be able to have them start accruing on day one of their employment, but have them not start using that time until 90 days of employment with the company. I also have a lot of clients right now asking about PTO buckets. So if you have your sick and vacation time together, if you can still do something like that. And the answer is definitely yes, you can do that, but you still need to make sure that you're following all the requirements under the law. So including the accruals, the usage, and the carryover. So that can get a little complicated with PTO buckets. We can move to the next slide. I'm not going to go through all of these, but if for any of those Michigan employers, if you go to leo.gov and look for the FAQs or just type in ESTA FAQs, you can get all of this information as well directly from there. They've done a really nice job with the FAQs for the qualifying reasons. So we can skip down to the definition of a family member. One more, there we go. So the only thing here I really want to point out is number 7. So all the other definitions of a family member are something that you typically see in a time off policy or a medical leave type policy. Number 7 is really expanding this. So it says any other individual related by blood or affinity whose close association with the employee is the equivalent of a family relationship. So this means if Jerry is feels like family to me, then I can take time off for any of those qualifying reasons for Jerry as well. All right, we can go to the next slide. So notice to company, again, these are something you can read directly on the FAQs, but something to note for this is the first box there, employees must provide reasonable advance notice of their intent to use the paid earned sick time based on the circumstances. This is going to get a little sticky because that reasonable notice is not something that we can define as an employer. So as long as it was reasonable to the employee, we need to really not be questioning that. Okay, we can go to the next slide. In terms of documentation, as an employer, you will not be able to request documentation to support that time off until they are off for 3 or more consecutive days. So not till day 4 of being off sick. And any out-of-pocket cost that the employee has to pay to get that documentation from their healthcare provider, you will have to reimburse that as the employer. So again, that's going to cause some challenges for employers on whether or not you're even going to want to request documentation. Okay, next slide. Some other considerations, if you do have any union contracts in place, your CBA is going to be, how do I want to describe this? You won't have to follow ESTA until you have to renegotiate your CBA. So that will take precedence for anything with ESTA. So that kind of gets you off the hook if you're a union shop. There is a 3-year record keeping requirement, so make sure you're keeping documentation for everything for 3 years. A couple other really important pieces are the time increment. So whatever the smallest increment of time that your timekeeping system tracks, so a lot of timekeeping systems track in like 6-minute intervals, you will have to allow the time off in that smallest increment of time, no greater than an hour. So any policies now that say you have to take it in a half day or full day increments will no longer be compliant with the law. And again, as the law is written right now, in terms of retaliation, any retaliation, so any tangible employment action, terminating, disciplining, transferring someone, reducing their pay, etc., that takes place within 90 days of someone utilizing this sick time, it will be presumed that this is in retaliation for them utilizing their rights under the law. That is one of the things that they're going to hopefully change if this proposed bill goes through. But that, as of right now, is a little scary for business owners as well as HR professionals. Okay, let's move on real quick. We'll go through some minimum wage increases. This again is for Michigan. So you will have a minimum wage increase both on January 1st as well as February 21st, 2025. So make sure you are keeping an eye on both of those. All right, next, you can skip down 2 slides actually. So good news here, if you haven't heard already, the Department of Labor, Fair Labor Standards Act, that was going to increase the salary threshold for classifying your positions as exempt from overtime. That was shut down. So we will be going back to the rates that were pre-July 1st, 2024. So good news on that front. And then real quick, we'll go through, we probably don't have to go through all the slides, but if you want to move on to the Form I-9. So obviously, one thing that you heard a lot about with the Trump campaign is his immigration reform. So Form I-9's audits are going to start increasing. As you see the numbers here, they increased 4-fold in his first year of presidency last time. So if you have not conducted an I-9 audit to make sure those are in order, now would be the time to do so. And Raymond can obviously support you in doing that as well. All right, I'll pass it back over to you, Sam.
Great job, Katie.
Thank you.
Well, thank you all so much for joining us today. Katie, Jerry, Tony, excellent presentation. We received a lot of great questions in the chat. Thank you all so much for participating and engaging with us today. To honor everyone's time, we are going to wrap up in the 60 minutes that we had set aside. So I want to make sure that all of our attendees can get back to their lives as needed. We're going to go ahead and follow up with anyone who sent in a question, whether either through your Raymond advisor or a member of the team that spoke today. But again, thank you so much for your time in joining us today. We appreciate it. A recording of today's presentation will be provided along with the slide deck, and have a wonderful day. Thank you.